December 2025. Economists publish forecasts for 2026. Goldman Sachs, Morgan Stanley, Deloitte all say the same thing. The United States economy is fine. Goldman Sachs forecasts stronger gross domestic product growth of 2.6% for 2026. Morgan Stanley expects 1.8%. The consensus forecast is around 2 to 2.2%. This is normal. The average growth of the American economy over the past 20 years is just around 2%. Unemployment? The unemployment rate will rise to 4.5% in 2026, compared with 4% in 2024. This is slightly higher, but still historically low. In 2009, unemployment was 10%. In 1982, 10.8%. Inflation should decline to approximately 2.4% in 2026, according to the December forecast of the Federal Reserve System. Not the ideal 2%, but much better than 9% in 2022, or even 2.7% now. By all indicators, the economy is stable, there is growth, unemployment is low, inflation is falling, but there is a huge problem. Americans do not feel it. The University of Michigan Consumer Sentiment Index stood at 53.3 in December, slightly higher than the previous month, compared with 50 in June 2022, when inflation was at a 40-year high, 53.3 out of 100. This is monstrously low. The historical average level is around 85 to 90. People feel almost as bad as in 2022, when inflation was 9%. But now inflation is 2.7%, the economy is growing, unemployment is low. What is happening? Why does the data say everything is fine, while people say everything is bad? The great divergence. The reason for the gap between spending and sentiment, the diverging fortunes of wealthy Americans and those with more modest incomes. The top 10% of income earners now account for approximately half of all spending, which is the highest share since officials began collecting data in 1989. The key to the puzzle, the economy is split. The top 10% are thriving. Stocks are rising, the Standard & Poor's 500 up 17% in 2025. Wages are high, income from dividends and rent is increasing. Dividend and rental income has shown particularly resilient growth in the post-pandemic economy, reflecting both an aging population transitioning into retirement and rising asset prices. The top 10% spend money. They buy homes, cars, travel, dine at restaurants. The remaining 90% are struggling. Lower income consumers, whose wage growth is slowing, will face increasing pressure on what remains of their disposable income as inflation remains at 3% or higher. Their wages are rising more slowly than inflation. Prices for food, gasoline, and rent are increasing faster than incomes. The result? In sentiment surveys, all voices are equal. The rich and the poor each have one vote. But in economic statistics, votes are weighted by purchasing power. The wealthy spend more, their spending carries more weight, and the data looks good. Statistics reflect the spending of the wealthy. Surveys reflect the feelings of everyone. That is why the data says the economy is growing, the wealthy are spending. While people say, I am suffering, the poor are cutting back. Unemployment is rising, but slowly the unemployment rate will rise to 4.5% in 2026. From 4% to 4.5%, that is an increase of 0.5 percentage points. It sounds small, but it means 800,000 additional unemployed people. Job growth is expected to turn moderately negative in the first quarter of 2026, as high tariffs, weaker immigration, and elevated interest rates restrain labor demand. Hiring is slowing. Large companies are cutting staff. Small companies are not hiring. Labor demand in late 2025 has unquestionably slowed as large firms seek to reduce headcount, while medium-sized and small businesses postpone further expansion of their workforce. With labor force growth averaging 29,000 jobs per month in the third quarter, conditions are ripe for a rise in unemployment. 29,000 new jobs per month is nothing. Before the pandemic, the norm was 150,000 to 200,000 per month. Why is hiring falling? Reason 1, tariffs. Trump imposed massive tariffs. The average effective tariff rate on goods imported into the United States rose by several percentage points above expectations. Companies pay more for imports, production costs rise, profits fall, and they hire less. Reason 2, immigration. Trump sharply reduced immigration. Slower population growth due to a steep drop in net migration weighs on aggregate consumer spending. Fewer people means fewer consumers, less demand, and fewer jobs. Reason 3, artificial intelligence. We could easily imagine further increases in unemployment in the near term if either productive artificial intelligence applications arrive faster than expected, or corporate management teams increase their focus on reducing labor costs in 2026. Companies implement artificial intelligence, automate, and lay off workers. Inflation, the eternal problem. Officially, inflation is falling from 9% in 2022 to 2.7% in 2025. Inflation should decline to approximately 2.4% in 2026, but people do not feel it. Why? Because prices are not falling. They are simply rising more slowly. Imagine this. Milk cost $3 in 2020. Inflation of 9% in 2022 means milk costs $3.27. Inflation of 2.7% in 2025 means milk costs $3.36. Inflation falls from 9% to 2.7%, but milk is 12% more expensive than in 2020. For consumers, this means that prices for everyday goods and services are still rising, continuing to strain household budgets. People remember old prices. They compare today's prices with 2019 to 2020, not with last year. And compared with the pre-pandemic period, everything is 20 to 30% more expensive. We continue to hold the view that tariffs will weigh on the labor market and exert upward pressure on inflation, reinforcing that the United States economy is experiencing stagflation light. Stagflation light is slow growth plus high inflation, not a catastrophe, but unpleasant. Statistics say growth of 2%. But for most Americans, life has become more expensive and harder. Let us examine three main problems. Housing has become extremely expensive. Home prices have surged. The median home price in the United States in 2020 was $329,000. In 2025, it was $420,000, growth of 28%. In addition, mortgage interest rates have risen. In 2020 to 2021, rates were 2.5 to 3%. Now they are 6.5 to 7%. What does this mean? Suppose you buy a home for $400,000 with a 20% down payment, which is $80,000. The loan is $320,000. In 2020, with a rate of 3%, the monthly payment was approximately $1,350. In 2025, with a rate of 7%, the monthly payment is approximately $2,130. That is an increase of 58%, almost double. For a family with an annual income of $70,000, this is 36% of income spent on the mortgage alone, plus taxes, insurance, and repairs. The result is that millions cannot buy a home. They rent. But rent has also increased. Average rent in the United States has risen by 20 to 25% since 2020. Housing consumes a huge share of income. This is the main reason why people feel poor. Food prices are another problem. Food prices have increased by 25 to 30% since 2020. Eggs, milk, bread, meat, everything is more expensive. A grocery trip that used to cost $100 now costs $130. Why do prices not fall? Companies raised prices during the inflation of 2021 to 2022. But when inflation slowed, prices did not return to previous levels. Companies became accustomed to high prices. Profits are at record levels. Taken together, these sectors paint a picture of persistent inflation in 2026. Cars are the third major problem. The average price of a new car in 2020 was $38,000. In 2025, it is $48,000, growth of 26%. In addition, interest rates on auto loans have increased from 4% to 7 to 8%. Monthly car payments have increased by 40 to 50%. Many people cannot afford a new car and buy used ones instead. But used cars have also become 20 to 30% more expensive. The combined result of these three problems is clear. Housing is more expensive. Food is more expensive. Cars are more expensive. Everything essential costs 20 to 30% more. And wages? Average wage growth from 2023 to 2025 is 3 to 4% per year. Inflation has consumed all wage growth. In real terms adjusted for inflation, most Americans are poorer than in 2020. Who suffers the most? Lower income consumers, whose wage growth is slowing, experience the greatest pressure. The bottom 50% by income are the most affected. They spend most of their income on food, housing, and transportation, precisely the categories that have become the most expensive. The middle class, from the 20th to the 80th income percentile, also suffers. These are middle-income households that continue to feel inflationary pressure. We previously noted that these households feel the strongest impact of inflation on their budgets. Only the top 10% feel comfortable. It is important to note that the top 10% of income earners are the driving force of consumption, as their income increasingly shifts toward non-labor sources, including dividends, interest, and rent. The wealthy own stocks, and stocks have risen by more than 50% since 2020. The wealthy own real estate, and prices have increased. The wealthy receive dividends, and companies pay record dividends. The wealthy get richer. The poor get poorer. The middle class stagnates. Debt is rising. People cannot cover expenses with wages. What do? They take on debt. Credit cards. Credit card debt in the United States reached $1,170 billion in 2025. A record. Credit card interest rates are 20 to 25%. People pay enormous interest. Auto loans. Defaults on auto loans are rising. People cannot pay. Student loans, $1,700 billion in debt. Payments have resumed after a pause. People are drowning in debt. This is not visible in gross domestic product statistics, but it is reality. Both are correct, but they are looking at different things. Statistics are correct. The economy is growing on average by 2 to 2.6%. That is a fact. Unemployment is on average low at 4.5%. That is a fact. Inflation is falling from 9% to approximately 2.4%. That is a fact. But on average, hides enormous inequality. If one person ate 2 meals and another ate none, on average each ate 1 meal. But one is still hungry. People are correct. Most feel worse than 5 years ago. Prices have risen by 20 to 30%. Wages are not keeping up. Debt is rising. Purchasing power is falling. Wages must exceed inflation over a sustained period before households feel they are moving forward. The problem? Wages have not outpaced inflation in the past 4 years. They have lagged. Only now, in 2025 to 2026, wages are starting to grow slightly faster than inflation. But it will take years to make up for losses from 2021 to 2023. 3 scenarios for 2026. Economists provide 3 possible outcomes. Scenario 1, base case, 45% probability, light stagflation. We assign a 45% probability to growth above trend, accompanied by nearly 3% inflation and 4.5% unemployment. Growth exists, but it is slow at 2 to 2.2%. Inflation is above the Federal Reserve's target at 2.7 to 3%. Unemployment is rising to 4.5%. This is not a crisis. But it is not prosperity either. Heading into 2026, the U.S. economy increasingly moves toward a late stagflation scenario. GDP growth below the typical 2% trend, while inflation remains uncomfortably high. For ordinary people, life remains expensive. Wages grow slowly. Debt burdens weigh heavily. The sense of crisis continues, even though statistics say everything is fine. Scenario 2, optimistic, 25% probability, growth acceleration. Given large tax cuts, Federal Reserve rate cuts, and deregulation supporting risk-taking, there's a reasonable chance of upward growth in 2026. Taxes are lowered. Trump. The Fed cuts rates. Companies invest. Growth accelerates to 2.5 to 3%. Unemployment falls. Inflation remains manageable. For people, hiring increases, wages rise, people start to feel better. But this scenario requires that tariffs do not harm, unlikely, immigration recovers, improbable, and AI creates jobs, uncertain. Scenario 3, pessimistic, 30% probability, recession. This scenario would worsen current light stagflation conditions, contributing to declining consumer sentiment. Inflation rises to 3.5% or higher, creating conditions for a rapid monetary policy reversal in which the Federal Reserve returns rates to 4% or higher, and unemployment rises to 5% or more. We assign a 30% probability to this outcome next year. Inflation does not fall but rises above 3.5%. Tariffs hit the economy. The Fed is forced to raise rates back to 4 to 5%. High rates. Companies lay off workers. Unemployment 5% or more. Consumers stop spending. Recession. If this occurs, real GDP growth quarter to quarter may turn negative in the first half of 2026, and unemployment may rise. For people, job losses, crisis, fear. What should people do? If you are in the top 10%, you are fine. Continue investing in stocks and real estate. The economy works for you. If you are in the remaining 90%, control debt. Do not take credit card debt at 20 to 25%. Pay down debts aggressively. Build an emergency fund. Unemployment is rising. Risk of job loss is higher. Keep 3 to 6 months of expenses in cash. Demand higher wages. The labor market is still relatively tight. If your salary has not grown 10 to 15% since 2020, you have lost purchasing power. Demand a raise or look for a new job. Invest if you can, even small amounts. Stocks over the past 5 years have grown over 50%. If you do not invest, you fall further behind the wealthy. Prepare for volatility. 2026 will be a year of uncertainty. Tariffs, inflation, Fed elections, new chair in May, geopolitics. Be flexible. Have a plan B. Final thought. The U.S. economy in 2026 is a story of 2 Americas. America 1, top 10%, prospers. Stocks rise, asset income grows. Statistics reflect their success. America 2, remaining 90%, struggles. Prices are high, wages lag, debt grows. Surveys reflect their suffering. Statistics say 2% growth, everything is fine. People say, I am suffering, this is a crisis. Both are correct. Statistics measure averages. People measure their experience. When inequality is enormous, averages lie. They hide the fact that most suffer while a minority prospers. The reason for the gap between spending and sentiment? Diverging fortunes of wealthy Americans and those with more modest incomes. The question is not who is right, statistics or people. The question is, why does the economy work only for a few? And until that question is resolved, people will feel a crisis, even when GDP grows by 2%.